Welcome to episode 5 of Compounding Brothers. How have you been, Paul?
I've been great, Joaquin. It's been a while since episode 4, so happy to be back. And let's get to it.
It's been a fantastic ride. It's been very much aligned with what we've been discussing. There are so many opportunities that I feel like a kid in a candy store, as Buffett would say.
Indeed, we now we're, the bifurcated market that we've been talking about for throughout all the episodes has yielded some great opportunities, and I think we're just getting started.
Spot on. As always, this is the disclaimer. All the content is only information. All our opinions are not recommendations to buy, sell, or hold any securities. Consult your guru, your spiritual advisor, your financial advisor. But everything we do here is only for fun, informational, and entertainment purposes. And I thought important to keep score and put the chart with which we started this channel. And we had our 6 themes or theses, and many of them are working out nicely. Cheap manufacturing, the picks and shovels are on a run and it's only getting started. And this is 25% return annualized because of the hit they took on Friday. They took it in the chin after the new, trade war between the reaction of the Trump administration to China imposing additional constraints to the export of rare earth minerals and batteries. The Chinese are playing the long game and they can see what's coming. And Trump essentially said, "Oh, you want leverage? There it goes. I'm going to impose another 100%," and everything came crashing down. If you are not enjoying this decline, you should not be investing, because it creates new opportunities, or it opens new opportunities for us to reinvest capital. Natural gas is clearly the Cinderella of the story, but it's going to become very pretty very soon. Solar batteries, we couldn't have had better timing. Our 2 picks are going to be delivering outstanding returns for many years. Gold is clearly the star. We spoke about gold in episode 4, I believe, and we think that this is maybe second inning, right, Paul?
Yep, that's right. And just like Buffett always used to say, we like prices going down because it gives us the opportunity to buy more of what we think are going to be great investments in the future. So I think we're beefing up, at least I am, beefing up my natural gas exposure. And we'll get to the reasons why a little bit later.
Yeah.
But I agree with you. The gold miners and the materials are definitely things that we add to when we see these sort of crazy nutty days when people decide to throw the baby out with the bathwater.
I tell my investing son, or my investor son, Axel, that the stock market is the only market that when there is a for sale sign, people stamp it out.
Yeah.
So then housing, we think we are, and we said it in our last episode, that housing, we were too early, and we think that there's going to be incredible opportunity. If you didn't watch episode 4, go and look it up, because we explained the reasons as to when rates come down, and they're going to be coming down because we are in an easing cycle. The opportunity of locked, trapped home equity is going to be huge, And when rates come down, supply is going to come up, refis are going to come up, credit is going to explode. There's going to be a liquidity effect, and there's going to be a flood of repressed transactions by this crazy, Fed chairman that we have, that eventually is going to cave, and rates are coming down, and all those stocks that we discussed there are going to go to the moon. We cannot get enough of those shares right now.
When the Treasury Secretary publicly mentions the need for a housing emergency status, you look at things like Boise Cascade, UFPI, and where they were on Friday, and you kind of scratch your head and say, well, if nobody's getting it, I'm gonna keep just increasing my exposure, because those are going to be sure winners, as is Freeport McMoran and NUE, and well, got Rocket Mortgage, obviously. So these are great stocks to own, and they haven't been our best performance, but that theme is naturally going to take a little bit more time to play out. But we're still have very.
And this is just as a sample of the stocks that we like. We discussed in our WhatsApp channel Brad Jacobs, QXO, and we like BLD, Top Builder, and we like Builders First Source. Anything in housing that has a strong moat and is cheap is going to do great in the next 2, 3, 4, 5 years. Again, everything is opinion, not advice. Consult your financial guru. Today we're going to be talking a little bit about emerging markets and China. In the future, we're going to be talking about international and emerging markets. We think those are the themes. This is the areas where we want to play, and there's huge opportunity there. Paul, one of the things that is being popping up in the press and in the financial media is this bubble discussion. And I thought it would be nice for us to, first of all, sort of dispense with this "are we in a bubble" question. And it's unequivocal that we're seeing an investing boom in the space. Clearly, this is something that we touched on several times in this channel, and at the same time that we've been warning viewers of the frothiness of the market, we think this is a market that has long ways to go. The fact that something is expensive doesn't mean that it needs to go down soon. Corrections, 10% or more corrections happen on average every 3.5 years. Bear markets happen on average every 5-6 years, so we wouldn't be surprised that there was a correction, but we think that there is also a high probability that significant portions of the market continue marching up. And the reasons for this are multiple, some of which we're going to be discussing soon. There is a huge investing tailwind. There is all the deregulation coming from the new administration, from the One Big Beautiful Bill, all this massive investing in infrastructure, which people say is egregious. And I like to compare with how much the UK or Britain invested in the railroad. And the investments in the railroad were close to 6% of GDP, sustained over multiple years. We're not even remotely close to that. And arguably, AI, as we're going to be discussing in a minute, is potentially way more transformational and revolutionary than what the rail was.
Yeah, and there's one thing that is very clear. There is a bubble in bubbles. Everybody's talking about bubbles, right?
Yeah.
So normally when you've got everybody and their mother calling the top and speaking about bubbles, that normally doesn't tend to coincide with a top.
Yeah.
Or in my experience,
It's almost as if when the last of the skeptics is converted, that the bubble pops.
That's right. And I think I personally believe what you're saying, that there are tailwinds from deregulation and from other government policies, the Fed easing cycle, and things like fiscal dominance, which are going to be good tailwinds. They're coinciding with a tectonic shift in technology, an absolute new revolution like we haven't seen since the early 1900s, right?
Yep.
So, and you talk about SPAC boom, meme stock mania. There's another one which is which we saw in the dot-com bubble, which was just an IPO craze.
That's coming. That's coming to a theater near you soon.
Yeah, that's when we'll know, when we're probably much closer to the top. Um, but to me, it doesn't feel like we're there. I think we're all cognizant of the dangers, the elevated valuations, but to me, it doesn't feel like it's there. And I always remember Grantham when he exited Japan, when Japan was trading at 35 times earnings, and it went to 65 times earnings before it burst. So I think people are being biased because of recent experience, and they're not seeing some of the tailwinds that we think are going to probably propel markets further and set them up for a bubble eventually. But I just don't feel it now yet.
Yeah. Yeah, and as we try to summarize on the left of the page, clearly there are unmistakable animal spirits concentrated in the AI and its surrounding ecosystem. There are many investors that are plowing billions and billions to unproven startups that are going to end up disappointed. It's very hard to imagine that all that money is going to enjoy happy returns in the next decade. However, this spirit of magical thinking is not dominant. People are still skeptical. We're not seeing, as you pointed out, we're not seeing the SPAC boom that we saw at the end of 2021. We are not seeing the meme stock mania. There are some concentrated meme stocks in the nuclear, or in the quantum compute space, but nothing that is so generalized. I have yet to see the GME equivalent. And we are seeing a technological revolution of sorts. And as every case before where humanity improve its condition through a technological revolution, there is capital destruction, and this is price of progress, right? So as Paul and I been, recommending, or to ourselves, not to you, but to ourselves, is we don't need to buy property in crazy town. We can enjoy the party and then go back home to same town, to the sectors where the cash flows and the valuations are healthy. And I think that's the takeaway here. We're just showcasing how in the top left-hand side chart, the meme ETF is not even yet back to the mid-2023 peak. And at the bottom, you can see how far are we from the crazy valuations in meme ETF stock that we saw end of 2021 and 2022, when they were even in the aftermath of the GME crash. There were Senate hearings as to why some individual investors were limited from trading on the GME, on the GameStop stock. And on the right hand side, we're seeing the great, fantastic news and opportunity that this market is delivering for us. We're seeing correlation come down dramatically to levels not seen, for many many years. And this is a stock picker's market. When you see correlations go down, that means those are signs of a healthy market, a market where investors are discriminating. Some things are going up, some things are going down, but there are still good reasons. It's not everything moving in unison to the same tunes, and this is good news. And this is another indicator why we think we're not ready yet to see a sharp decline and surrender the strong momentum that the market's been exhibiting in the last couple of years.
Yeah, some people won't remember, but the Wall Street Journal used to have the dartboard, like a monkey throwing a dart at a dartboard, where you had a bunch of stocks and seeing how those stocks performed. And when you have an unhealthy bubble market, anything you hit went up. That is not the case at the moment.
It's not. And high valuations are concentrated. We know that 10 companies account for 40% of the S&P 500 weights. And in the top left-hand side chart, what we see in the blue bars, where the EPS growth is coming from. In Q1 2024, growth was 50, then 35, 32, 31, 28, and in Q3 and Q4, we're going to see those EPS growth at 14, and a convergence of valuations between the Magnificent Seven and the other 493 shares in Q4 2026. So if we're right, we're going to see a lot of deflation in the valuation multiples for the Magnificent Seven, who are also the ones who are making the brunt of the capex spending associated with the build-up of the data centers and the GPUs and the energy generation to produce intelligence. And I think what we're going to see very likely is that even though the earnings may come healthy at an aggregate level, the composition of those earnings is going to show that the 493 are essentially lifting significant more weight than they used to in the last couple of years.
Yeah, for things to remain somewhat the same, that'll have to be the case. Or it could be that as we see the downward Magnificent Seven EPS growth, we might hit a little air pocket, which we've discussed the reasons why these things can happen, as depreciation takes a much higher percentage of earnings. It's going to get eaten up by depreciation on all this new capex equipment. So
yep.
There could be a little bit of an air pocket, but we do believe that this new revolution is sustainable.
Yeah. In the years prior to this investment cycle, the hyperscalers of today used to spend between 9 and 13% of their operating cash flow in capex. In 2026, they're going to be spending 63%, right? So to your point, those are the guys who are going to be seeing their cash flows crater. And if revenues don't come very quickly to justify those investments, those guys are going to see their valuations, coming back to earth. And here there are two other pieces in this mosaic that we are all the time building in our heads. At the bottom, you see that many of the AI-related firms have issued a 141 billion. Essentially, this is companies giving Wall Street what Wall Street wants. If people are clamoring for their shares, they're just issuing shares and diluting themselves. And there you can see Oracle and Broadcom, etc. On the right-hand side, you see how the CoreWeave insiders immediately after their lockup periods expired, they rushed to sell. So you can tell how there are some cracks in the more frothy areas of the market, which are the tiles in the mosaic that give us reason to think, together with the declining velocity of earnings growth, that these valuations are going to be seen pressuring.
Putting this into context of our major themes, investment themes, this is why we visit Crazy Town but go home to Sane Town at night. We don't play in the hyperscaler markets. We have the vehicle to which it's levered, which has margin of safety in the case of nat gas and sustainable energy, which are areas that we think have a sufficient margin of safety where we don't suffer permanent capital impairment, where some of these CoreWeave, as an example, could be one of these companies that suffers a big headwind and may never recover.
So the Cape is the cyclically adjusted price earnings ratio that Robert Shiller created, invented, and still computes. It's clearly showing that on average the market is expensive. We are seeing massive AI investments to nearly triple between calendar year 2025 and 2030 to reach 1.2 trillion. And then on the right hand side you see this report from Bain saying that to justify these investments 2 trillion in combined annual revenue is required, and what they're seeing is a shortfall of 0.8 trillion. Who knows what's going to happen, but clearly the bar is set very high for these investments to be justified. And clearly there are other reasons these hyperscalers are spending, and we discussed this in episode 2 and in episode 3, where simply because of competitive strategy and industrial organization dynamics, these hyperscalers cannot afford not to spend. In fact, there is a quote by Mark Zuckerberg who said that he wouldn't be concerned about squandering a few tens of billions of dollars. He thinks the risk is to spend too little. So that is sort of another tile that paints the thinking that these guys have when they make capital allocation decisions today, and that's driving this bubbly sentiment that is bubbly but not yet bubbling, as we say there.
Yeah, and Zuck has to definitely spend more money, because his last foray, which was Lamo, was a complete disaster, and he's basically had to scrap it and start rebuilding again and offering people insane amounts of salary to poach them.
Yeah. The stakes are so high that paying these people hundreds of millions is still cheap. And the reason for that is that every training run costs hundreds of millions of dollars. So if you have the wrong hypothesis, or you are branching into the wrong side of the tree, it's going to cost you so much that it's cheap to have the best of the best inside. So when you spend time and effort in compute to train your model, you're not wasting your time. So to some extent, it's a rational decision to pay these people these crazy salaries that are unfathomable for any normal human being.
It's totally rational when you think about the path dependency of technology decisions, and the kind of winner takes all outcome. And in the case, the all here is owning an industrial revolution. So the stakes are high enough. The path dependency is very strong. So it does make sense.
Yeah, in the meantime, the godfather of all of them, our friend Jensen, keeps collecting. And we are still in, or we're getting closer to the Wile E. Coyote moment for all these players, right? So we've been warning people, we don't need to play that game to make money and to be successful. Again, opinion, not advice, but our sense is that we're getting closer to that Wile E. Coyote for the AI ecosystem, which is nothing to say about how incredibly transformational this technology is going to be for decades to come. And one of the ways to look at this is the Buffett indicator, which takes the ratio of the Wilshire 5,000 capitalization to GMP, and we are like way north of 200%, which shows, to a great extent how much these companies play in the ecosystem are dragging, valuation higher. And if you think in terms of future realized returns, if you invest in the index, you're going to get disappointed. At the same time, this is the chart you loved. It was important to bring it back because it shows that the fact that it's expensive doesn't mean that it is over, right? And this is superimposing the cycle, the current cycle, when essentially AI was launched in terms of GPT through the peak compared to similar parallels in the dot-com boom. And as you see there is still room to go just to get to the levels at which we were back then.
That's right.
And our friend John Hassman is always a good ballast in the storm, because one of the things in one of his last publications, he talks about, this is August 14th, he talks about the fact that if you take valuations today and invest in the market at current valuations forever, your expected return at current valuations is under 6%, which is a petty, high yield bond return for the risk of owning equity, clearly unacceptable. And he argues when people realize that this is what's going on, is that the bubble crashes. And what people lose track of is that the valuation of the assets, the DCF, as you can see in the bottom right hand side, the DCF is essentially the discount. The valuation today, the intrinsic value of an asset, is the discounted value of the cash flows. And the cash flows do not change when your initial value increases. So the final value is determined by that, but those cash flows, and the initial value is the only remaining variable, independent variable, determining your return. So if your initial value goes up or is too high, then your ROI is going to be very low. And that's essentially what he's saying. And people have this magical thinking that because an asset has gone up in the past, that essentially is harbinger of the asset going higher. And in the short term, that might be true for market dynamics and momentum, but in terms of the eternity of the asset, that's very wrong. And the higher the price you pay today, the lower your realized returns are going to be. So when people realize that they're buying assets at under 6% return to take equity-like risk, is when the bubble comes crashing down.
And the only thing I would add to that is that 5.7% is probably a nominal number.
It is nominal. That's a very good distinction as well.
Okay, so think about having a bond forever, and look at the fact that in the last, I think it's been 80 years, the purchasing power of the U.S. dollar has eroded 98%.
Yep.
So if you held that bond forever and you're making 5.7%, you are in real terms losing your shirt.
Yep. And on top of that, I invite people to look up Buffett's Fortune article, How Inflation, the article title is How Inflation Swindles the Equity Investor. Inflation is equity market kryptonite. And when people realize that we are in a regime of higher inflation, then those discount rates go up very quickly, and those cash flows are discounted much more rapidly, and their investment of capital becomes way more expensive, and those cash flows become even worse, and it becomes very, very nasty very quickly. So in the same piece, Hassman brings this analogy of when you are in a free fall, assuming that you have the unlucky situation that you come into an elevator comes disengaged and starts dropping like a rock. What is the best thing you can do? And some people say, I may jump the second before. That doesn't work because you are accelerating at 9.8 meters squared. The best thing you can do is not to get into that elevator, right? So which is what we are advocating here. No need to jump into the Standard & Poor or the index elevator. But the second best thing, if you already jumped into the elevator and it comes down, is to spread your body weight in the floor, which is essentially diversify. And today, there are wonderful diversifiers that we discuss here, such as materials, namely gold, silver, platinum, lithium, etc., such as healthcare, that is very cheap, such as energy, and there are opportunities where you can spread out your portfolio without ever having to suffer this elevator crashing down. This is where we transition into the logic behind this AI infrastructure buildup. What we're seeing is incredible adoption of AI technology. And the analogy is that in the 19th century, what we did in the Industrial Revolution was to automate muscle, right? First steam, then electricity, then the assembly line, etc. In the 20th century, we automated the assembly line and we automated communication and control, right? It's the age of the computer. And in the 21st century, we're going to be automating reasoning itself. We're going to be automating intelligence. And what does this mean is that this is probably the deepest, most transformational economic and technological revolution imaginable, because what we're essentially doing is bringing the marginal cost of cognition very low. It's not going to be zero, but it's going to be essentially very close to the cost of generating cognition via electricity. And that essentially is creating a flywheel. It's creating a flywheel. Why? Because in contrast to prior technologies, AI is self-improving. The more it's used, the more the model learns, the more the models are refined, the more you give feedback to the AI provider as to whether the responses were accurate or valuable, and the more that AI uses that data to become better, right? In contrast to steam or electricity, that once they're propagated, they stay there. They cannot improve simply by use. There is still massive, and I want to stretch this, maybe 100 times opportunity for efficiency gains. The metaphor that I would use about the state of AI and the age stages of a human being is that the AI is at the same stage of development as when a baby is sucking its thumb. It's starting to recognize its own existence. It's starting to recognize what's this. And the opportunity for growth in AI is tantamount to the opportunity for growth and development that a baby has since it's sucking its thumb until it becomes a functioning adult, right? So the opportunity is along multi-dimensional. Algorithms are going to get better. Data quality has huge opportunities to improve at the training level, at the post-training level. Architectures, compute is obviously is going to continue to get better. Energy efficiency is going to improve. Systems are going to be designed in a way that are better at using the model itself. And we're going to be seeing efficiency gains that are dramatic, that are exponential, and that are going to drive significant improvements in value and in use. there is also this exponential economic impact from chip recognition, because today, with an AI that is like a baby, we're seeing infinite demand. So the current suppliers of AI cannot keep up with demand. As this baby becomes more useful, demand is only going to increase over this level. It creates a lot of economic value. It's going to expand exponentially. And that's going to drive productivity gains, that's going to drive more demand, and the cycle is self-reinforcing feedback loop of compounding. So we're seeing in contrast to many naysayers who are saying, oh, the models are not improving, their models hallucinate. In 2 years, that's going to be gone. By the same token that today we see as natural to have Grok or ChatGPT or Anthropic, answering very convoluted and complicated questions, advising us on many things, or actually coding, we're going to be seeing agents. We're going to be seeing thinking peers that are going to be adding significant more value. So this self-reinforcing feedback loop has only one limitation. The only constraint is energy and governance, of course, because we have all the alignment problem. But what we're seeing here is we're far, far, far from reaching the ceiling in this technology.
Yeah, the only thing that I would add is let me contextualize it in a way that anyone can understand. Us as rational beings, we normally follow a scientific process for decision making. We say, okay, should we do this or that? We sort of follow a decision tree type of methodology, and we figure out what works, and then we keep going at the next stage. If we find something doesn't work, we sort of go back to step one and retool. What AI is doing is kind of the same thing, right? But it does it at light speed compared to a human being. So if you're having trouble believing in the potential of AI, I would urge you to reflect on how you think and how long it takes you to go through a good decision-making process, and then think about how quickly AI can perform that task, and then it'll go one step further and say, okay, my reasoning tools could be even more efficient. So instead of having more branches on a decision tree that I have to evaluate, it'll cut those branches down, because it'll say a lot of these are noise and not relevant, so it cuts them down. So it retools and relearns the scientific decision-making process. So you get to where you want to get logically as a human being, but you get there at light speed compared to us, and then you improve the process. And just think about that to the 100th power, and you will barely scratch the surface of what this thing can eventually be. And the other thing too, you mentioned the skeptics who are talking about hallucinations, this, that. Llama, I mentioned Llama was a disaster, and Zuckerberg's got to redo this. ChatGPT came out with 5, and people are saying, are going back to 4. These are part of the innovation process. So don't let those things fool you into thinking that AI is a fraud or it'll never work. These things are to be expected.
It's important to note that these things are to be expected, but also to bring reality and do a simple checkup. And the last open AI algorithm went to the International Math Olympiad and got a gold medal. So this thumb sucking baby is already getting gold medal in the International Math Olympiad with all its hallucinations and everything else. The kids from the US who get a silver medal go to MIT, right? The high schoolers who get a bronze or a silver medal, let alone a gold medal in the International Math Olympiad, go to MIT. So this baby who is still, sucking its own thumb already got a gold medal. So I think it's important to have that reality check because this thing is unstoppable. This thing is just starting, and the value creation that this technology is going to unleash is beyond our ability to imagine or comprehend. You touched several times on how linear our minds are, how difficult it is for us to understand exponential curves. This is potential exponential. We cannot even, scratch the surface of what these things are going to look like in 2 or 3 years. Not only the data is going to improve, these guys are creating synthetic data and back propagating it to see what sticks. They have virtually infinite compute to try these models. They are trying the mix of experts in which they have multiple different domains, and they have like a quarterback who essentially decides which part of the brain. So it's not one brain, it's like 100 brains, and each brain is smarter than the smartest person in each specific domain. They are trying tools such as essentially letting the algorithms reason longer, and that's also yielding very good results. But it's also going to be improvements in sheer computer science, in the foundational science around AI that is going to be incorporated into what are just LLMs. So this is just starting. This is only the beginning. This is, in terms of baseball, we're not talking about the first inning. We're talking about the batters getting warm. They're warming up. The first ball has not been thrown. That's how important it is to understand. And if you're going to miss this wave, it's all on you, right? I'm not planning on missing this one.
No. Neither am I.
So, reality checks. These are excerpts from an interview to Dell's COO, and warranted to some extent. They're talking their own books, but they don't have reason. They're sold out, right? They don't have more capacity to sell. So essentially, what are they saying? They're saying demand is surpassing our wildest dreams, right, on the left hand side, and on the right hand side, it's saying AI applied within Dell is making us dramatically more productive in terms of developers, installers, salespeople. We're making better decisions, faster decisions. We are getting greater insights. And this is the other thing. Companies are training models for their own data needs. Many things that we don't even see, which is they take an open source model. They take the parameters and then they train the model. They post-train the model on their own data, which makes the model very, very relevant to their needs. And this is happening under the hood without anyone realizing. This is going to drive productivity. What else are we seeing? We're seeing that the energy consumption density of this is only exploding. He says not too long ago, a standard data center would have 10 to 12 kilowatts of power on a square where the rack sits. Our first big rack scale NVIDIA Hooper designs were 100 kilowatts. Now we are regularly over 200, heading toward 500, and then toward a megawatt. And this is today. With today's technology, with today's demand, with today's value, this is exploding. On the right-hand side, you see an interview to another expert, essentially saying, An Anthropic report released in September found that roughly 3/4 of companies are using cloud to automate work. These machines are coding better than anyone. So if you have a programmer or a coder who is leveraging Anthropic, their productivity and their output quality is exploding. They are 10 times more productive, and the quality of the code is dramatically improved. There are no mistakes. It requires less debugging. The debugging is much faster. It's enabling technological transitions from like legacy systems in COBOL to new systems in new programming languages that are better suited to today's technology and data. We found that today's best frontier models are already approaching the quality of work produced by industry experts, okay? So especially on the subset of tasks where models are particularly strong. So how much will customers eventually be willing to pay for these services? It's incalculable. The OpenAI CFO, she was thinking is at all not unthinkable. They were going to have $2,000 and $20,000 subscriptions because the value is unfathomable. So at the same time this is happening, there is a realignment of alliances and JVs and cross investments. One of the last announcements in this incestuous industry where everyone is to some extent related. It's like Games of Thrones, right? Everyone is related to one another. OpenAI, AMD announced massive computing deal, and this happened 2 weeks after NVIDIA announced significant investment in OpenAI. So this is interesting. This is something we're paying attention. A lot of people have raised their antennas and saying, "Oh, this is again, vendors finance, and this is, what the same thing that happens with Cisco." We think that there might be something of that, but we have a different take. The take that we have is a take anchored in industry structure. The take that we have is a take anchored in the fact that there is platform economies of scale that the dominant players today want to perpetuate and reinforce into the future. And if you take those lenses and if you take those filters, what's going on seems very rational to us.
There is an opinion out there that we are seeing again the vendor financing that eventually took down Lucent, Nortel back in the early 2000s. And, you get CoreWeave, and it resembles that. And I can see why people are drawing parallels. But I think here there's a lot more to it. Number one, the demand right now is insatiable. So NVIDIA doesn't have to do vendor financing in order to sell it. Right, and you also made a good point where NVIDIA doesn't have the capacity to supply the entire market. AMD, for example, and Intel provide two platforms where that can provide sort of lower end chips that are still needed, and a lot of them are needed. So
yep.
This sort of platform and network effect that's developing is probably a positive thing for the industry.
Absolutely. So exactly, if you think that we are in what are the parameters of this AI infrastructure market structure, is massive fixed cost in R&D to create the chips, in fab manufacturing to manufacture the chips, design and manufacture the chips, massive fixed cost initial investment to train the models and deploy them, right? And then there is near zero marginal cost in use, and that creates a natural monopoly logic. On top of that, NVIDIA has the software ecosystem built around CUDA, and they want their standard to be the industry standard. So this creates this platform economics dynamics. They want to lock the standard and then drive the network effects. And then what, to your point in number 4 on the left, what this drives is a tier market equilibrium, because let's think about it. Who is producing the cutting edge chips? NVIDIA is, and then some custom ASICs such as Trainium and the TPUs, the tensors that Google is manufacturing, but for the most part it's NVIDIA. Now, if we believe that what's going to happen is that what's going to drive demand for compute is going to be inference, because people are taking the models and they are post-training them on their data, then there are no enough NVIDIA GPUs to run all the inference demand. So it is in NVIDIA's interest to create an ecosystem of complementary chips that are going to be running inference that enable people to continue buying their cutting edge technology, because if there is no enough inference to run around, who's going to be training new models? So in NVIDIA's mindset, it makes perfect sense to actually, seed the entire ecosystem to make sure that the whole pool of demand is going to continue favoring their cutting edge GPUs, so people continue investing in the latest technology, driving the frontier and utility of AI higher, because that only favors themselves. And I want to make one more point. The other point is because of, and you raised this issue, you said maybe one of the reasons of this sequence is NVIDIA makes an investment in OpenAI, so OpenAI has enough money to buy NVIDIA's chips through Oracle, and then OpenAI turns around and makes an investment in OpenAI makes an investment in AMD. So someone might say, oh, this is betrayal, right? Essentially, Sam Altman, the same way he betrayed Elon Musk, is betraying, the Godfather. The reality is that Jensen Huang cannot buy anything. The only thing he can buy is his own shares, because he is so large that any purchase that he makes is going to raise antitrust concerns. And by investing in OpenAI and OpenAI investing in AMD, he's essentially owning a piece of AMD. So he's indirectly acquiring, and that's to your point, is essentially creating the impression that he is sponsoring a competitor and therefore reducing the antitrust concerns at the same time that he indirectly now owns AMD.
Yeah, and most importantly, he's got an indirect policy I guess direction. He can direct policy indirectly for AMD through that investment, even though it's sort of a second derivative investment. It's still he can move levers in the network, which is very sensible when you think about a sort of monopoly, oligopoly. The economic models always teach you that when you're in those situations, you're better off cooperating.
Yep. Essentially, this is a co-petition scenario, to quote our old professor Barry Nailbooth. These are all frenemies. And what the Godfather is doing is seeding the system, and he understands perfectly well that he has way more money than anybody else to throw at R&D to continue subsidizing the adoption of CUDA and the software led by NVIDIA, and that the portability and the forward compatibility of its chips enable people to continue happily buying the latest generation, knowing that at the latest generation they can train the best, and then after the new generation comes, they can use the old as inference. So essentially, what, to the point on the number 6 on the right hand side, what we're putting there is what you espoused at the beginning, is creating this stack bifurcation. There is a stack that is essentially standard centric and is cutting edge, and then there is another stack which is more vertically integrated and is the second class chips used for inference, right? So it's fascinating what is unraveling in front of our eyes. Demand is so large that that's essentially the fundamental premise, that demand is going to continue driving utilization, right? If that assumption breaks because there is no enough value created or there is disappointment in the adoption, this logic breaks down. If there is an issue in terms of there is a demand miss that triggers what we call there reflexive deleveraging, that's another concern. If there is software portability risk, right? If you cannot agnostically use, your model or your software in multiple chips, then that's a problem. That's why people are investing in PyTorch, in Triton, and there are all these mechanisms by which people are becoming more chip agnostic. That's also driving adoption and demand. And then the ultimate constraint, if all of this is true, is going to be power. If there is no enough power available, this whole thing breaks down, right? Yeah. The demand will require power, and that's why there is an arms race in terms of investing in power. This is the reason why China has just to gain leverage in the upcoming negotiation with Trump put an export license on batteries. These guys understand perfectly well that whoever has the power will have the intelligence, right? And then there is the regulatory and political risk, and then finally there is the geopolitical and the issues around supply chain nationalism and potential energy shocks, which are a good problem to have, because that would mean that demand is so high that we don't have enough energy to go around. So, in sum, all of these things in our minds are almost natural developments in an industry characterized by the attributes that the AI infrastructure market structure is.
That's right. And funny you mentioned China. There was a recent news item that I read where China is going to be shutting down a lot of its pipeline access to Europe for nat gas and is rerouting it to China. And you know why? Now we all now, after this episode, know why China needs so much electricity. Mm-hmm. It's a solar powerhouse. It doesn't have, the only hydrocarbon it has is coal. And it's been cleverly making coal to liquids and to things like polypropylene, but I suspect that a lot of that coal is going to end up as energy for AI.
Yep. Negentropy. Whoever is the richest in negentropy, so negative entropy, that's going to be rich. And clearly, China is negentropy poor, and Russia is negentropy rich. So that's why China is so motivated to do whatever Putin needs, because they need the natural gas coming from there. And right. And the repurposing of those pipes makes a ton of sense because China sees it coming, and the only sort of left behind is Europe, because Europe is poor in negentropy, and now essentially Russia is rechanneling all that natural gas from Europe to China, which brings back the need of Europe to rely on U.S. natural gas, which has been one of our theses since the beginning.
That's why I always say that Angela Merkel was probably the worst leader in the last 100 years in Germany.
No, she was a Putin mole.
Yeah, she shut down.
There's no other way to comprehend how stupid that woman was.
Yeah, she's from East Germany, so she could have been a mole.
Yes, yeah, she's an Eastern Germany mole into the Western world, and that's why she was so friendly with Putin. She probably was an agent. who became
It
prime
wouldn't
minister.
surprise me because the decision to shut down nuclear was one of the
Yeah.
most stupid things.
She was essentially doing
Policy
Putin's bid.
decisions.
Absolutely. But then Putin doesn't need them anymore, so they can relaunch their nuclear reactors and they can burn coal and they can do whatever they need because Putin now has an eager client in China.
That's right.
So I thought I became poetic. I shared this with you earlier, and I was trying to convey what all this mean for us, and this poem came working with ChatGPT, so credit to where credits due, and we came up with this. We dreamed of fire and it burned. We dreamed of light and it learned. Now cold hums hymns in unseen halls, a million minds in silicon walls. It mirrors thought, desire, and flaw, a newborn God without a law. Each prompt, a prayer, each weight, a will. We feed it hope, it hungers still. To birth such power and stand aside is to sculpt the storm, then close our eyes. He who builds the God too late will kneel before what he creates. So haste, O makers, teach it grace, before it learns the human face. For in its gaze we soon may see what gods once saw in you and me.
I think as much as a poem, that is a prophecy.
It is. I try to create this notion that we were created and now we're becoming creators of something that is going to become our digital God. And if we are too late to embed that digital God with the grace we need from her, then we're going to be doomed to essentially kneel before what we create. So it came nice, I like it, and I thought it was interesting to share because we are essentially building a digital God.
Yeah.
And one of the interesting things, this chart on the left comes from evolutionary biology, and it shows in the horizontal axis the body mass of mammals, and on the vertical axis it shows the brain mass. Both scales, as you can see, are log scales.
Yep.
The dots that are within the red oval are hominids. And as you see, there is a very neat logarithmic, co-logarithmic relationship, except for the hominids, including humans. That means that there was such a huge evolutionary reward in increasing the size of the brain that those who prevail, escape that curve. So if that was true in the process of natural selection, imagine what it is going to be when we have artificial intelligence selection, artificial intelligence creation. This curve can go dramatically more upwards and to the left, increasing the density and the size of the artificial intelligence compute power. And not only we have as humans bigger mass, there are other, as you can see, if you project, the horizontal line, there are other mammals who have equal size as we do, but they are not even close to us in terms of compute power. That tells you that not only we have bigger brains, we also have more efficient brains. So we are going to be seeing bigger AI and way more efficient AI because we're going to be behind all these different domains, all these different drivers, all these different dimensions in which we can enhance the reasoning and intelligence power of these machines.
And as we know, human beings don't understand nonlinear functions. And what we're looking at here, number one, is a nonlinear function with respect to humanoids. And with artificial intelligence, go back to earlier in the show when we were talking about how we use things like regressions Bayesian logic, things like that, in order to make good rational decisions, and then we rework them. But the difference with AI is speed and the ability to learn from each process to improve the process, sharpen the knife, if you will. So when we look at AI, here we could have a completely nonlinear function that just goes vertical.
Absolutely.
In the case of AI.
And to add, it doesn't sleep, it doesn't get tired, and it has the ability to restructure itself to become more effective, which I cannot restructure my neural network to become smarter at math or anything, right? I have an endowment of which I'm very happy, but I cannot restructure it. AI will be able to improve that. So it doesn't sleep, it doesn't get tired, it can restructure its neural network as many times as it needs. What is the constraint? Well, we have on the left. Intelligence is thermodynamically constrained. We do not escape the laws of thermodynamics. We cannot escape the Landauer's principle. We cannot escape entropy, right? And essentially, every time you compute, every time you erase a bit, every time you measure something, every time you make a decision, every time you digest data and becomes to make it information, and information to make it intelligence, and intelligence to make it wisdom, you are creating entropy. That means that you're dissipating heat. That means that you're consuming energy, right? So we have hard ceilings, as we say there, because of Turing, of Gödel, and of Wolfram, right? We don't have perfect foresight, and there is infinite improvement of compute and of understanding, and therefore you cannot have, if infinite compression, we will be infinite intelligence, because there's no infinite energy to go around. And if in the extreme, I'm becoming philosophical here, but if you have infinite intelligence, you have total entropy, you have total chaos again. So the demand for cognition is infinite because of the value that it creates in terms of we want to embed intelligence in cars, in robots, grids. We have super linear demands of everything that goes into that, because when we embed cognition into all those things, we need power, we need cooling because of the laws, the second law, the Boltzmann laws of second law of thermodynamics. We need cooling because we create heat dissipation, and we need copper, and we need lithium because we don't have enough natural gas to go around. We'll need solar, and we need to have silicon demand. And then energy supply becomes the binding constraint. And then a new capital cycle has begun to supply this infinite demand of electrons. And then what you and I arrived at is when we talked in episode 1 about the picks and shovels, when we talked about in episode 2 about natural gas, when we talked in episode 3, there is a common thread, right? When we talked in episode 3 about solar plus silicon, essentially all of those are total collectors of entropy reduction. What we are essentially is fostering a hyper growth in entropy reduction, because we're going to be consuming low entropy substrates to create thinking, to create intelligence.
That's right. That's a nice thread through the theses over time.
And all the things that we've been discussing come together in this conversation, because we talk about the total collectors in terms of semi-cap equipment. We talk about the energy producers. We talk about EQT and RRC. We talk about the materials producers in ALB and SQM, and all of this comes together in this significant drive of building our digital God.
Sam Altman here is discussing the increasing energy that queries now take, here he mentions that the average query uses about 0.34 watt hours on what, which is what an oven would use in a little over a second, and or a high frequency light bulb in a couple minutes, and that is substantially more, for example, than a Google search takes. Infinitely more, right? And I can also, from my experience, I've been doing some M&A work, and I can tell you that now I use Grok to analyze the contracts when I'm reviewing contracts with lawyers. It doesn't take the work that I have to do reviewing it, but it's extremely helpful to upload the document and use good prompt engineering. Saying, okay, you're an M&A lawyer at the best law firm in New York, and you're representing the buyer. Look at all the clauses and see which ones can be improved for the buyer's side. What are the risks? Then you ask about inconsistencies within the clauses, and then in a few minutes you'll get a whole bunch of information, after which you'll probably do some follow-up questions. So I think it's very real. The energy that it's taking now is humongous, and as Sequoia mentions, these data centers are getting huge, have huge power demands. We're having constraints on energy to supply them. They mentioned specifically a 2-year wait for diesel generators, which, as we discussed before the call, is kind of a good reason why Caterpillar's up so much. They must be producing diesel generators, as quickly as they can. But these data centers are
they're selling the earth removers to essentially flatten the earth for the data centers, and then they're selling the generators, the diesel generators for the operation of the data centers. So they are, before and after.
Yeah, that's right. You need shovels, backhoe shovels. You need the trucks. Then you need the
I missed that
generators.
one. I confess I missed that one. I'm not going to hold it against myself because I got a few right, but I didn't see that one coming. I saw Generac, and we own Generac. Again, opinion not advice, but we missed Caterpillar.
Yeah, I missed it too, and I should have known better, because I've spent most of my life as a mining guy. I should have known better. But there you go. We don't dwell on our mistakes.
That also shows to what extent this technological revolution is propagating through the economy, right?
Yes, that's right. There are second, third order effects that are being fed by the economics of building a data center. Even local businesses in Tennessee, where one of the biggest, I think, XAI is building a massive data center. You think about also the jobs in construction, local economies as far as food and things like that.
Yep.
These are the things that are in not allowing unemployment to rise much further. You know,
If I was reading that if you're a mediocre electrician, you can make 100 grand in West Texas.
oh, that would not surprise me.
Yeah.
That would not surprise me.
The welders, electricians, anyone around building, and then all the things around, heat exchanges, cooling, technology, avertive there, generation, then, that's going to drive gasoducts and pumping stations, and this is like a massive tailwind for the economy and for economic growth.
And also think about, you know, we're getting sidetracked here, but it's an interesting point. The world over, we're seeing plunging birth rates. And in the U.S., you certainly have plunging birth rates. You've got the immigrants who are leaving. You've got a population that is preferred to opt out of STEM areas
Fields.
in fields of study, and you don't have as many vocational schools as you used to back in the 50s and 60s. You know, where you have plumbing, HVAC technicians, electricians.
Well, now the education department is forcing Harvard to fund education in vocational professions.
Right, but what we're going to have is we're going to have this gap because we might have at least a 5 to 10 year gap where these professions are going to be in very short supply. So when people tell me, oh, unemployment's going to go up through the roof and this, I don't believe it. It doesn't fit well with me and the level of capital expenditures that I'm seeing in infrastructure, data center infrastructure. So I'm a little bit against that view. And we're going to have to see a realignment of labor, knowledge, and career types. So, but that's sidebar.
The Larry Summerses of the world and the Austin Goolby's political hacks at the Fed are going to start crying wolf because of wage inflation, and that's the right inflation. That's the good inflation that we want. That's the inflation that we had repressed for so long, and we discussed in episode 2, where people are clamoring and crying wolf when wages go up, and that's a healthy development, and that's essentially what's going to allow the market signal to be interpreted by the youth and gravitate into professions that are needed. So we need those wage inflations.
Well, that's what's going to stop. Remember the protest after the 2008 debacle, Occupy Wall Street, and all these things. Having jobs in all these areas that we're talking about related to technological development. Is going to mitigate that risk. And we know, as you well pointed out, that inflation risk in salaries is a good thing because it allows people to live better. Monetary-based inflation is a bad thing.
Yep.
So
exactly right. So this page is on the left, showing that data center power demand is going to increase 165. I think this is going to be more than this. I think if all what we just discussed is remotely right, we're going to be seeing triple the demand for data center power, and this is playing to our theme number two, which is natural gas. Natural gas is going to get tight, very tight, in 2026. As the Bloomberg article on the right hand side showcases, record LNG wave will breed long term demand. And then on top of that, you have all the tokenization or digitalization of the financial world. And this is also very energy intensive. Because this is also going to be creating an incremental demand for the data centers around assets and markets that are going to become, they're going to become part of blockchain technology.
That's right.
So this is the same, more demand for data centers, and all of this is happening when energy is at the lowest valuations and at the lowest weights of the Standard and Poor 500 since 1926. So this is again another opportunity to make generational wealth, and another generational opportunity to make generational wealth. And in terms of what we expect to happen very soon is that energy, and this is the fact set data of essentially bottoms up earnings, analyst earnings projections for 2026, and you're seeing energy already, being the fourth after information technology and materials and industrials, all the wave, all the propagation effect from left to right of AI. Energy is going to be one of the sectors with the largest earnings growth in 2026. So we are seeing massive demand at the cheapest valuations when earnings are about to inflect.
Energy, when the graph that you showed that at 3%, there are, if you look at how much money is out there invested in asset classes, and energy being 3%, the gold sector, I still go back to Warren Buffett. Warren Buffett could probably buy the entire global gold equity market
with the cash that he has in the balance sheet. Yeah.
So it's
and there on the right you have the chart you sent me of the ratio of gold to oil.
Yes, yeah, that other than the spike when gold went negative in the pandemic.
When oil went negative.
When oil went negative in the pandemic.
Yeah.
If you take that sort of
there's nothing like
exogenous, there has never been a time when gold miners were more profitable, and I think probably by the year end, some of the big miners might actually be debt free. So it's impressive, and
they're becoming bonds.
Yeah, but very high yielding bonds, because
exactly
these
15, 18, 25 yielding bonds.
Because these companies, you have to remember that they're probably making, in some cases, over $2,000 an ounce after all-in sustaining cost. When we did the gold presentation, we were investing in companies that had all-in sustaining cost, which is all costs plus the replacement, the maintenance capex costs, and those were $1,300 to, let's say, $1,600 at the top end of the range of our picks. And these guys are making over 2,000 ounces. They're making over 100% on that. And
I bought a few. I told you I bought a few GDX calls, and November last year they are 850% higher. And I'm not planning on touching them because I think I think that's going way higher. Opinion, not advice. I think the gold train is just barely about to leave the station.
Yeah, I think so too.
And the Fed balance sheet is a risk. We don't think that's going to create much problem because we think the Fed is going to become very accommodating simply because they don't have other option because Trump is going to engineer, its peaks into the FOMC, and we're going to have soon a new chairman, this lame duck, pathetic guy that we have today who doesn't understand the first thing about what's going on. Is going to leave in Q2 next year for good, and I think this is going to be a great run for lower interest rates, and that's going to create and enforce and promote the reduction in rates and mortgage rates and housing, and that's going to drive economic growth coupled with all what we discussed around AI. At the same time, we were touching about the demand and the bottlenecks in qualified labor. If you are not there, the winter is coming because there's going to be higher inflation. And if you're not in one of those professions, there's going to be wage inflation that is going to drive, CPI inflation. There's going to be in energy inflation because AI is an unstoppable steamroller, and gold is your Valerian steel, right? To stop the bad guys coming from the north, the
That's
Night
right.
King.
It
And
was
and this is something that you were pointing out. One of the constraints is to transmit electrons. We need copper, and copper is another one of these bottlenecks.
right. The two comments I want to make. One was I saw a chart which was um, put out by Rick Rule
Mm.
on Twitter, and it
Mm-hmm.
was the difference between buying a house in 1947 and in 2026. And it was the same price in gold. It was 1 kilo bar of gold bought you a house in 1947, and the same kilo bar of gold bought you the same house. So effectively, while the U.S. dollar debased 98%, gold held its purchasing power through that same 80-year period. So I think that's a very, very powerful statement and a good reason why everybody, I'm not saying go all in on gold or gold miners, but you should have anywhere between 5 to 10% of your portfolio in gold in order to try and mitigate loss in purchasing power.
You're,
The
you're you're very conservative. I think I wouldn't hesitate to have 25% in gold or in leverage gold through miners, right? So maybe you don't need 25% of your portfolio in gold miners because it's leverage gold, and I prefer the miners much better than gold for the reasons we discussed in that prior episode. But I think if you apply a leverage factor of 3.5 to 5 to your miners holding, and that's around 20-25% of your overall portfolio. For me,
Mhm.
opinion and advice, I wouldn't be at all, feeling but relieved of
Yeah,
having
and
that given the geopolitical and monetary and fiscal situation in which we're in.
yeah, and I think you're right. And I'm probably wrong. I'm just quoting the figure from one of the big institutions where they did the portfolio efficient frontier.
Yeah, well,
Um,
you know what I think about the Capcom. Yeah,
so we'll leave it at that.
yeah.
And I will apologize because old habit. Got to get those bad financial ideas out of my head. But but here on copper, I don't think people understand the magnitude of the shortage of supply in the copper market. Uh, this this article here talks about First Quantum's Cobre de Panama. This
Yep.
company, this mine that First Quantum owns, has been shut down
Yep.
by presidential decree. It
Yep.
provided about 5% of GDP and 75% of the country's exports. Now, how in God's name can politicians be that stupid? And this is handled very environmentally soundly. And just because you have some NGOs and people that don't like progress, they want to shut a mine down. And in Peru, where I live and where I've had a career in mining, there is probably about $65 billion that are in copper projects waiting to be permitted. It is astounding. And the environmental impact study, which is something that should take about a year, takes about 3 to 4 years. Then forget it. To get the mine built, the last company I was with, we had a $700 million capex project in southern Peru, and that was going to take 3.5 years to build.
Mm-hmm.
So when we think about the speed of the demand for these resources due to the technium and the delays and the blackmail that's occurring at government level, NGO levels that are setting these projects back, we are looking at
the Indians in the U.S.
Yeah.
They're desecrating their ancestors' land.
Well, that's Resolution Copper, which is owned by BHP and Rio Tinto. And the Resolution mine has been known for at least 20 years, if not more. And they just can't get it approved. And another one is Hudbay's Copper World, which looked like it was going to get permitted, and then at the last minute, Biden put a stop to it. So I would.
What do you think will happen with all these mines and processes if copper hits $50 a pound?
Well, I think there's going to be a rush.
They're going to bomb the Panamanian government, and they're going to bomb the Aboriginal tribe, and they're going to start mining that copper, because essentially that would be the end of our civilization as we know it.
Well, that's right. And in the U.S., you've got huge copper deposits in the state of Michigan too. So I think what we need is the government to declare copper a national interest and critical to the future of the United States, because what China is doing, China is basically owns most of the smelting and refining capacity of the world now. So they're basically buying what's called concentrate, which is sort of dirt that you produce at a flotation plant that's got probably, let's say, 35% copper, right? And some other byproduct metals. They take that to China, and then China smelts it, refines it, and they keep all the copper. So in the supply chain, the U.S. is in a very dangerous spot. And unless we make a decision to give the go-ahead to projects like Resolution, Copper World, and there's a few other ones in Arizona, we're going to be in trouble. And I would also say that the U.S. should give some funding for smelting and refining in the U.S. so that we mitigate some of the risk of China not not providing any of the copper cathodes, which they might want to keep to themselves or for their friends.
Yeah. So, as that article points out, every incremental gigawatts of data center capacity requires 6,000 tons of copper. So, and copper supply is very inelastic for all the reasons we just said. That means that incremental demand is going to go to price very quickly, and AI is going to pay copper at whatever price because of the value of intelligence, which means who is going to be crowded out, and then you're going to have EVs coming behind. Each EV, uses 3 to 6 times more copper than an ICE car, and then you are going to have the autonomous robots that are going to be very copper intensive, and then you're going to have the prosumer and the mini grids that are going to require more copper interconnects, and then you're going to have all the new generation coming on board that is going to be interconnected, and then you're going to have all the copper needed to build more grid capacity to accommodate all this. So this becomes non-linear very quickly.
Oh yeah, and also that there's a similar situation in silver where we're running supply-demand deficits on a yearly basis. And as you may know, silver is the reference for conductivity. It's not.
To what extent can we replace? To what extent can we replace copper and silver with aluminum?
Oh no, it's been tried before. High tension lines have been in a lot of cases were changed to aluminum, but you need to have less distance between towers, so it's not as effective.
You need more steel, so you get rid of the copper constraint and you land in the steel constraint.
Exactly. So it's not it's replaceable, yes, but not as efficient. And what's been discussed quite a bit is graphene, because of its conductivity.
That's very expensive to produce yet.
But that's it. Graphene is a potential solution, but it is very expensive to produce, and we need copper yesterday, not today. And graphene still has a bit of time before it becomes economic.
So if we didn't make the point sufficiently clear with this conversation, we added this page, going back to Mark Andreessen saying that software is going to eat the world. But in the AI era, software now, it's copper first.
That's
and
right.
Everything else, energy, lithium, land, water, follows. So this turns the digital revolution into a materials arms race. And therefore, we will need more copper, because efficient model architectures that squeeze more cognition per joule and per kilogram of metal is not enough. There is not enough copper to go around, and that's the conundrum. And how do we solve this to some extent? With mini grids. So if there is no enough copper to decarbonize, how do we bridge the tension? With lithium. And that's what we discussed in episode 4. And with that, we jump into the emerging markets. Is another one of our themes. It's exploding. There is renaissance in interest in the Chinese markets. When we started talking about this a year ago, when the policy paper published by the Ministry of Finance in China, and people were looking at us as if we had 3 heads. The Shanghai Composite is at a new 10-year high. The Chinese market essentially decreed, the Chinese regulators decreed that the stock markets need to go up. And if you allow me an anecdote, an SOM colleague told me a story, Paul, and she invited Claudia and I for dinner once, and then she told us that the government in Shanghai can control the weather. And when I heard that, I thought she had, one, two, or three too many drinks, and then she was hallucinating as an AI model. But then she said, no, 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 listen to me. The government in Shanghai controls the weather. I said, how come? Well, there is a regulation in Shanghai by which if the temperature in the day, the peak temperature exceeds 35 Celsius, the construction workers get paid and they do not have to work. Therefore, the temperature never reaches officially 35 Celsius, right? That's how communists do it. That's the way to do it. You have those guys working at 38, 39, but the official temperature is never above 35 Celsius. That's how you manage a totalitarian 1984 dystopian Orwellian economy. So when these guys came out and said that they had decreed that the stock market had to go up, I took them seriously, because 15 years earlier I had this conversation with this colleague of mine in New York, who was also an SOM alum, who explained me how these guys manage their economy. That's why I put a significant portion of our portfolio behind that decree. And these guys went out and told the banks that they were going to have plenty full of reserves to buy shares. They told all the mutual funds, they told the insurance companies that the central bank was going to enable credit lines for them to go and buy shares. So who is not going to take that seriously? I did. Morgan Stanley didn't. Goldman Sachs didn't. None of the banks. They kept saying it's uninvestable. So now that the stock in China is 100% higher, Morgan Stanley comes out and said, we're raising a stock target. So when the stock could not be given away and we were buying it and we were like three-headed monsters, these guys were saying it's an investable. Right now that the stock tripled from the bottom and doubled since our average acquisition price, these guys come out and tell, now is the time to buy Alibaba. Right? You cannot make this stuff up.
God bless them.
God bless them. So, southbound buying, we already touched on this. These are the Alibaba metrics. Many people are going to get confused because they have two huge opportunities. They are investing behind instant commerce. They are driving scale in e-commerce in a new line within China. And they have essentially cornered the data center market in China. They have the digital infrastructure, they have the Quen models, they have AI ecosystem in place, and they have all the demands of the mushrooming AI ecosystem in China, and they're investing behind that. That's why their cash flows are going to suffer in the short term, and you listeners of this channel may have another opportunity to acquire. Opinion and advice, cheaper Alibaba, simply because people are confusing short-term cash flow decline with fundamental change in the opportunity for this company. So Alibaba is going to go back to what it should have been. The total revenue is growing 10%. Cloud Intelligence Group is growing at 26%. Alibaba International is growing at 19%. And here we are essentially summarizing some of the things they discussed in the earnings call. You can read it at your leisure. The point being is that even after the run that we saw in the last few months, with the decline of the last few days, they are barely at the same level they were in October 2021, right? And they are a way bigger, better, meaner, stronger company than they ever been, with significant more visibility and opportunities into the future.
Well said.
So, to wrap it up, we are finishing our episode 5. We touched and we brought together many of the themes we've been discussing. We are as bullish, opinion or advice, and as excited investing behind each and every one of them. We think that the energy opportunity is the one that it hasn't come to fruition yet, but we're so close that we really feel like a kid in a candy store. And any of these opportunities not only gives investors the opportunity to diversify away from crazy town, but also to invest behind generational opportunities, secular trends that are going to last decades in companies that have competitive advantage, they have low cost basis when they are commodities companies, or they have incredible modes when they are not. So we are seeing valuation aligned with opportunity, aligned with long-term growth, and this is something that we rarely see in an investing lifetime.
Sounds good. Well, that wraps it up for episode
Yeah,
5.
this is another tour de force, and we are going to be talking next about the opportunity to invest behind small cap value in emerging markets and in developed markets. And with that, it's been another great episode, Paul. Thank you for all your wisdom, and I had a lot of fun.
Thank you very much, and thank you for everyone listening to us. Make sure you click and subscribe if you like what you hear. Take care.